In my view, there is a very decent probability that a bottom is in place in both gold and silver and that it will find support. Now,
today's been a crazy day in the markets. We saw gold and silver down quite a bit. Gold ended below 1900, silver below $23. And we see in the stock market actually about 1,000-point drop in the Dow. Your take on what caused all of this turmoil in the markets?
We have to take a look at the overall picture and the upcoming FOMC meeting. And then we'll talk maybe about the report that came out, the advanced estimates for Q1, as well as the PCE today. But we've seen pressure in U.S. equities for the last week, solid pressure. And I believe there's two primary causes to that. The first is the anticipation of a much more aggressive Federal Reserve. Right now, the CME's FedWatch tool, which gives probability of rate hikes, is putting a 99.1% probability that next week they will announce a rate hike of the Fed funds rate of 0.5%. And then in June, a 77% probability that there will also be another 0.5% rate hike. The wild card is they have alluded to beginning the tapering process or reduction process, of their balance sheet. Of course, they concluded their tapering to zero of purchases, adding to the balance sheet, but it is now swelled to what, $8.8 trillion. I'd like to have just a millionth of that in my bank account, but a huge, huge balance sheet. When you add that to the enormous amount of aid and fiscal stimulus that the U.S. government had to go through during the pandemic and recession, that has taken our national debt sky high. And of course, that is a bullish undertone for both gold and silver, unquestionably. But the pressure we saw was the anticipation of tightening credit because businesses have gotten addicted to free money. They can do a lot of things when your borrowing costs are anywhere between 0 and 1%. The wild card, of course, that's recently come up is the major lockdowns in China, as they say they're having upticks in COVID-19. Of course, most of the free world is pretty much past that. The light at the end of the tunnel is a light that we're looking at now. In other words, we're able to move around the country and travel, and it seems as we're definitely at the tail end, but we're most likely at the new normal, however that pans out. But China took a different tack. They didn't vaccinate, and there were 500 cases in Shanghai. They virtually locked that port city down, which meant that a lot of the goods that they export to the United States, including the necessary microchips for automobile productions and electronics, aren't coming into our ports. So you've got supply chain bottlenecks again. You've got a very, very serious problem in that the economy in China could have a great contraction. And I think that, coupled with Federal Reserve tightening of monetary policy combined, is really what took U.S. equities lower, not just today, but all week. And so I think those were the primary components in terms of U.S. equities.
Do you see that the stock market could fall further from here? I know we're recording this on Friday. It's going to be released on Saturday, so the markets are still closed. When we open up Monday, what do you think is going to happen?
I'm not going to take a guess. Could we see a further decline? Yes. But that is going to depend on, I really think, the news that comes out of China over the weekend. If they continue to lock down more cities, they talked about locking down certain parts of their capital city. In other words, if their scenario gets worse where there's a higher probability of a greater economic contraction in China, then that would definitely pressure certain stocks lower. Many of these U.S. corporations have a vast percentage, or at least a decent percentage, of their income derived from their exporting their goods or services to China. So it will depend on that. The second thing is there's a war in Ukraine, and it's been escalating once again. The weekend seems to be a time when the market cannot react to changes in that conflict and the geopolitical uncertainty that it presents, or that results from that war. And so come Monday in Australia, and of course Monday in the US, we'll get kind of that catch up where market participants are able to react to additional news that wasn't present Friday as of now and is now present Monday next week. This is the only time the markets close. So we could see additional pressure. But I don't want to guess on whether or not it will continue to drop or it'll find support. What I can say is those are the primary variables that will influence the moves we see on Monday. And depending on how those unfold, that will determine what happens on Monday.
Now, you mentioned a bit earlier that we could have seen a bottom now in both gold and silver. Silver is below $23. It's right around the low range we've been seeing for around 2 years now. It has been lower than this. It was $21.50 or so back in, I believe, late September, early October, and it touched that again once after that. But do you think we could see further to fall, or is this the bottom in your view?
In my view, there is a very decent probability that a bottom is in place in both gold and silver and that it will find support. Now, I'm basing this on some technical studies that I've been looking at, but fundamentally speaking, we had CPI for March come in at 8.5%, 40-year high. But today, the government released the most recent data for the PCE. And of course, that is the inflation index that the Federal Reserve uses. And while it strips out food and energy costs, which bewilders me as to why that's the preferred Federal Reserve go-to inflation index, it still came in at 6.9. And what that means is that the last time we had a PCE that had that kind of year-over-year jump was in 1980. So for the last, 4 or 5 months, we've been talking about inflation at a 40-year high. Well, now, according to the PCE, it's at a 42-year high. So the Fed has long maintained this doctrine that it's going to peak and then it's going to begin to slowly diminish. And all of the data suggests the contrary. You know, the key right now to me is inflation. Because if inflation continues even at these levels or moves higher, as I believe it will, it's going to be hard to take the safe haven assets that are a hedge against inflation tremendously lower. Day by day, you have noise in the market. It can be up or it can be down. But on a longer term basis, as long as we have persistent inflation, which we certainly have now, there's going to be an underlying force that is highly supportive of both gold and silver prices. And with the war in Ukraine, which has added jet fuel to the fire, because inflationary pressures began long before the invasion, which occurred on March 24th. We really saw inflation levels pick up at the beginning of this year as we saw the CPI go into the 6s, then the 7s. And that was due to the end of a recession, pent-up demand, and not enough supply to be able to satisfy that demand. Then you added the war in Ukraine. In terms of energy costs, those have spiraled over $100 a barrel. Russia accounts for Russia is the third largest producer and exporter of oil in the world. U.S. is number one, Saudi Arabia is number two. Secondly, in terms of food costs, and these are the two of the primary forces behind higher inflation. There's others there, obviously. But I believe that Ukraine is the fifth largest producer of corn. And Russia, I believe, is the third largest producer of wheat. And so a lot of that wheat, of course, it's hard to for farmers to work in Ukraine when everything's getting destroyed, and most of the any of the workforce is in military uniforms. They're not going to be plowing their fields. There's boycotts against all kinds of goods in Russia, and wheat is a needed grain that's been exported from Russia into the European Union. So you're seeing inflationary pressures grow globally. And as long as that remains persistent, which I believe it will, it's hard to fathom gold or silver coming under tremendous pressure.